January 2025. Within hours of market open, the unthinkable happened. The world's most powerful bond market crumbling, a US president forced to retreat on the global stage, not by military might, not by diplomatic pressure, but by something far more powerful. European pension funds, quietly moving billions, Swedish institutions, liquidating $10 billion overnight, and the destination? Chinese RMB bonds. The very shift Washington feared most is now accelerating. What happens when the Treasury market loses its buyers? What happens when America's financial dominance faces its first real challenge? The answer will reshape everything you thought you knew about global power. Welcome back to Silver Radar. You know, my friend, if you've been watching financial markets for as long as I have, you've seen many storms. But what's unfolding right now, this is different. If you're someone who values straight talk about money, power, and what's really happening behind the headlines, then you're in the right place. Do me a favor, will you? Hit that subscribe button. Think of it as keeping a good newspaper subscription, except this one tells you what they won't. And tell me in the comments, where are you watching from today? New York, London, Mumbai, Singapore? Because what I'm about to share with you, it affects every corner of this connected world we live in. Let's begin. The financial architecture that has supported American power for 8 decades began showing cracks on a cold January morning in 2025. The U.S. Treasury market, long considered the bedrock of global finance, experienced a disruption that sent shockwaves through trading floors from New York to Tokyo. The 10-year Treasury yield breached 4.3%, a threshold that carries profound implications far beyond abstract market metrics. This was not merely another day of market volatility. This represented a fundamental challenge to the operating assumptions that have governed global capital flows since the Bretton Woods era. Foreign holders of U.S. debt, who collectively own approximately $7.4 trillion in Treasury securities, were reassessing their positions. Domestic institutional buyers, traditionally reliable absorbers of government debt, were demanding higher compensation for risk. The auction mechanisms that quietly fund American federal operations were experiencing diminished demand. The consequences materialized with striking speed. Within the first hour of trading, the Nasdaq Composite Index fell by more than 1.5%. Technology stocks, which have served as the primary engine of American equity market performance, were experiencing accelerated declines. The wealth effect that drives consumer spending in the American economy was reversing. Portfolio values were contracting, confidence was deteriorating. What transformed this market event into a geopolitical moment was the response from the executive branch. At the World Economic Forum in Davos, Switzerland, an American administration that had spent weeks issuing ultimatums to allies and adversaries alike abruptly shifted course. Threats of military action regarding Greenland were walked back. Proposed tariffs targeting European trading partners were postponed. Aggressive rhetoric gave way to frameworks for negotiation. The connection between these two developments was neither coincidental nor subtle. The bond market had imposed discipline where diplomatic pressure could not. It had enforced constraints that electoral politics had failed to establish. The mechanism was elegant in its simplicity. A government that requires foreign capital to fund its operations cannot simultaneously threaten the providers of that capital without consequence. The structural reality underlying this crisis reveals why the reversal occurred so rapidly. The American economy has evolved into a configuration where equity market performance drives economic activity rather than reflecting it. When stock prices rise, household wealth increases, consumer confidence strengthens, and spending accelerates. When equity markets decline, the sequence reverses. This creates a feedback loop where market stability becomes a policy imperative rather than merely an economic indicator. The technology sector sits at the center of this dynamic. American technology companies are engaged in an unprecedented infrastructure build-out, constructing data centers and artificial intelligence computing facilities at a scale that rivals previous industrial transformations. These projects require enormous capital commitments. They depend on access to credit at sustainable interest rates. When Treasury yields rise, corporate borrowing costs follow. Projects that appeared economically viable at 3.5% yields become questionable at 4.3%. The stakes extend beyond individual corporate balance sheets. Data center construction has become the sole area of robust growth in American private sector investment. Residential construction is declining. Commercial real estate development has contracted. Manufacturing capital expenditure remains subdued. If the technology sector's infrastructure spending slows or stops, the broader investment picture deteriorates significantly. The implications for employment, income growth, and economic momentum become severe. This explains why policymakers responded to market pressure with such alacrity. The administration's ambitious agenda, encompassing semiconductor manufacturing, reshoring, and expanded digital infrastructure, depends entirely on continued capital formation. Rising yields threaten the financial viability of these initiatives. They increase the fiscal cost of federal borrowing. They create conditions where the private sector may curtail investment precisely when public policy seeks to encourage it. The episode crystallized a fundamental tension in contemporary American statecraft. The pursuit of geopolitical objectives requires financial resources. Those resources must be borrowed from global capital markets. Those markets respond to policy signals and risk assessments. When policy creates instability or threatens creditor interests, capital becomes more expensive or withdraws entirely. The constraint is not hypothetical. It manifests in basis points and auction results. As markets stabilize following the policy reversal, a question emerged that extends beyond immediate crisis management. The buyers who temporarily stepped back from Treasury auctions in January, where might they allocate capital instead? The answer to that question would reveal itself in European financial centers, where institutional investors were quietly exploring alternatives that had been theoretical until very recently. The photograph captured a moment that financial historians will study for decades. Christine Lagarde, president of the European Central Bank, rising from her seat at a Davos dinner table, her expression carefully neutral, her departure deliberate and public. The American Commerce Secretary was mid-sentence, explaining why European nations should restructure their economies to benefit American workers. Lagarde walked out. This was not a diplomatic misunderstanding. This was not a scheduling conflict. This was the institutional manifestation of a rupture that had been building beneath the surface of transatlantic relations for months. The head of Europe, his most powerful monetary authority, had concluded that continued engagement in that particular conversation held no value. The symbolism resonated through finance ministries across the continent. What preceded this departure provides an essential context. Commerce Secretary Howard Lutnick had been addressing European leaders with a message that contained a remarkable internal contradiction. He urged Europe to avoid economic dependence on China. Simultaneously, he advocated for European industries to relocate production facilities to the United States. He counseled against offshoring critical manufacturing capabilities, while explicitly encouraging those capabilities to be offshored to America. The audience, composed of finance ministers, central bankers, and institutional investors, sat in visible bewilderment. The reaction from European officials moved beyond diplomatic discomfort into substantive policy reassessment. Sweden's AP7 pension fund, which manages retirement assets for millions of Swedish citizens, had already made its decision. Throughout 2024 and into early 2025, the fund systematically liquidated over $10 billion in U.S. Treasury holdings. The stated rationale was precise and coldly analytical. American fiscal policy had become unpredictable. Budget deficits were expanding without corresponding economic growth, and the risk of monetary debasement through Federal Reserve intervention had risen to unacceptable levels. This was not an isolated action by a single institution. It represented a pattern emerging across European financial infrastructure. The logic driving these decisions follows a straightforward calculation. European pension funds and insurance companies operate under fiduciary obligations to protect capital and generate returns sufficient to meet future liabilities. When the largest debtor nation in global markets exhibits policy volatility, threatens trade partners, and operates persistent deficits exceeding $2 trillion annually, the risk assessment changes fundamentally. The mathematics of diversification began shifting in boardrooms from Stockholm to Madrid. European institutional investors collectively hold approximately $1.3 trillion in U.S. Treasury securities. This concentration represents both historical momentum and the absence of comparable alternatives. For decades, no other debt market offered equivalent depth, liquidity, and perceived safety. That perception was now under systematic review. The threat that concerns European asset managers is not outright default. The United States possesses the capacity to print the currency in which its debts are denominated. This creates a different risk profile than conventional sovereign borrowers face. The actual concern involves monetary debasement. If American fiscal positions become unsustainable, the Federal Reserve faces a choice: allow interest rates to rise to levels that attract sufficient buyers, or intervene to cap yields through large-scale asset purchases. History suggests which option proves politically easier. For foreign holders of dollar-denominated debt, this creates an asymmetric risk. They receive repayment in nominal terms. The purchasing power of those repayments, however, erodes through inflation and currency depreciation. The bondholder gets dollars back. Those dollars buy less. The loss is real even as the nominal contract is honored. This is the scenario European institutions are now actively pricing into their risk models. The European Union's decision to suspend trade deal negotiations with the United States added a commercial dimension to financial recalibration. 20% of American exports flow to European markets. $350 billion in annual commerce now operates under increased uncertainty. American exporters who depend on European buyers face questions about tariff exposure, regulatory alignment, and long-term market access. The integration that defined transatlantic economic relations for 7 decades is being reconsidered. Christine Lagarde's words, delivered in a separate session after her departure from the dinner, carried unmistakable strategic weight. She spoke of revising European economic organization. She referenced building ties with nations that play by the same rules. The implication was diplomatically coded but analytically clear. The United States no longer fit that description in European institutional assessment. Canada had already begun its diversification. European policymakers were studying the Canadian approach with intense interest. The pattern was forming. Traditional American allies were constructing contingency frameworks. They were exploring alternative reserve assets. They were reducing concentration risk in dollar-denominated holdings. This created a practical question with profound implications. When European institutions reduce Treasury exposure, where does the capital flow instead? The answer was emerging in clearing systems and settlement platforms that had been built quietly over the previous 5 years, waiting for precisely this moment of strategic reorientation. The flower blooms in late winter. Magnolia denudata, known in English as the Yulan magnolia, produces white petals before its leaves appear. In Chinese financial markets, the term has acquired a second meaning: panda bonds, dim sum bonds, and now Yulan bonds. Chinese debt instruments carrying names that soften their strategic significance. But there is nothing soft about what these instruments represent. In Frankfurt, a clearinghouse called Euroclear processed a transaction that would have been impossible 3 years earlier. A German insurance company purchased 50 million euros worth of bonds denominated in Chinese renminbi. The issuer was a Chinese state-owned enterprise. The settlement occurred in Europe. The entire transaction bypassed the dollar system entirely. No SWIFT messaging, no correspondent banking through New York, no exposure to American sanctions architecture. This is the infrastructure that European institutions discovered when they began searching for Treasury alternatives. It had been constructed methodically, component by component, while Western attention focused elsewhere. The cross-border interbank payment system, known as CIPS, now processes over 80 trillion yuan annually in international transactions. Offshore renminbi liquidity pools in Hong Kong, Singapore, and Frankfurt provide currency stability without depending on Federal Reserve swap lines. Settlement mechanisms allow institutional investors to buy, hold, and sell Chinese government debt with the same operational ease they experience in Treasury markets. The growth trajectory tells a story that raw numbers might obscure. In 2022, European investors purchased $350 million equivalent in Yulan bonds. In 2023, that figure reached $700 million. By 2024, demand had expanded to $1.2 billion. The absolute amounts remain modest compared to multi-trillion-dollar Treasury markets. The rate of change, however, reveals shifting institutional behavior. What makes these instruments attractive to European portfolio managers extends beyond geopolitical diversification. The financial characteristics warrant examination on purely commercial terms. Chinese 10-year government bonds currently yield approximately 1.8%. American Treasuries of comparable maturity yield 4.28%. On the surface, this appears to favor dollar assets decisively. But yield comparison alone misses critical factors. The renminbi appreciated 4% against the dollar throughout 2024. A European investor who purchased Chinese bonds at the beginning of that year realized a total return, combining the coupon payment and currency appreciation that exceeded what Treasury holders achieved when accounting for dollar depreciation against the euro. The math becomes compelling when extended across multi-year holding periods. Currency stability introduces another dimension. The People's Bank of China maintains capital controls that limit renminbi volatility. For institutional investors, managing liability matching strategies, reduced currency fluctuation carries value. European pension funds with obligations denominated in euros face currency risk when holding dollar assets. Renminbi exposure, while still involving currency translation, has demonstrated lower volatility patterns over recent measurement periods. Then there exists the factor that European asset managers discuss in private, but rarely state publicly. China has not weaponized its financial system against foreign creditors. Beijing has not frozen accounts. It has not seized assets. It has not imposed sanctions that create uncertainty about whether bondholders will receive payment. The contrast with Western financial infrastructure, which has been repeatedly deployed for geopolitical objectives, creates a peculiar inversion. The authoritarian state appears more predictable than the democratic alliance. This is not an endorsement of Chinese governance. It is an observation about institutional behavior under specific conditions. When American policymakers threaten allies, impose tariffs unpredictably, and suggest territorial annexations, the risk calculation shifts. European fiduciaries are paid to protect capital. They are asking a straightforward question. Which system presents greater risk of arbitrary action affecting bondholders? The infrastructure supporting this shift extends into central banking relationships. The People's Bank of China has established currency swap agreements with the European Central Bank, the Swiss National Bank, and the Bank of England. These arrangements provide renminbi liquidity during stress periods without requiring dollar intermediation. A European bank needing short-term renminbi funding can access it through its own central bank. The plumbing that makes large-scale currency diversification possible has been installed and tested. Market depth remains the primary constraint on rapid reallocation. The accessible Chinese government bond market totals approximately $2.3 trillion equivalent. The U.S. Treasury market exceeds $27 trillion. This differential means Chinese debt cannot absorb wholesale Treasury substitution. No institutional investor can shift a $100 billion position from Treasuries to renminbi bonds without creating significant market impact. But substitution is not the relevant framework. Diversification is. A European pension fund managing 50 billion euros in assets might currently hold 45% in dollar-denominated securities. Moving 5 percentage points into renminbi instruments does not destabilize markets. Multiply that incremental shift across dozens of large European institutions, however, and the aggregate impact becomes substantial. By late 2024, major European pension funds had increased renminbi-denominated asset allocation from an average of 0.3% to 1.8%. Insurance companies showed similar patterns. Sovereign wealth funds, operating with longer time horizons and greater risk tolerance, were moving more aggressively. Norway's government pension fund Global, the largest sovereign wealth fund in Europe, disclosed a position exceeding $3 billion in Chinese bonds. The significance is directional rather than immediately quantitative. A multipolar reserve currency system is not established through sudden revolution. It emerges through incremental adjustment compounded over years. The infrastructure now exists. The instruments are available. The institutional behavior is changing. What remains to be determined is how this reallocation accelerates when the next crisis arrives. The ledger tells a story that political rhetoric cannot obscure. The United States federal government will borrow approximately $2.1 trillion in fiscal year 2025. This is not emergency spending responding to crisis. This is structural deficit spending during a period of claimed economic strength. The interest expense on existing debt now exceeds defense appropriations. The government pays more to service past borrowing than it allocates to maintain military superiority. This creates a mathematical problem that compounds with each passing quarter. Over the next 18 months, $9 trillion in Treasury securities will mature and require refinancing. The government must find buyers for this debt at interest rates the market will accept. If buyers demand higher yields, the deficit expands further because interest costs increase. If buyers disappear entirely, the system faces a funding crisis that forces immediate and dramatic policy adjustment. 3 scenarios emerge from current trajectories. Each carries distinct implications for businesses operating in global markets, and each requires different strategic responses. The first scenario assumes orderly adjustment. In this outcome, American policymakers implement gradual fiscal consolidation. Spending growth slows. Revenue measures are adopted. The deficit narrows over a 5-year period. Simultaneously, the technology sector's artificial intelligence investments generate productivity gains sufficient to accelerate economic growth. Higher growth produces increased tax revenue without rate increases. Foreign capital continues flowing into Treasury markets, accepting marginally higher yields as compensation for temporary instability. Markets stabilize. Dollar dominance persists, with modest erosion at the margins. This scenario requires political consensus that has eluded Washington for 2 decades. It requires technology investments to deliver returns that remain speculative. It requires foreign creditors to maintain confidence despite policy volatility. The probability is not 0, but it requires multiple favorable developments occurring simultaneously. Business leaders planning on this outcome are betting on best-case assumptions. The second scenario involves monetary dominance. Here, Treasury yields continue rising as foreign and domestic buyers demand greater compensation. At some threshold, likely between 5.0 and 5.5% on 10-year notes, the Federal Reserve intervenes. The central bank begins purchasing government debt in substantial quantities, effectively monetizing the deficit. Yields are capped through direct intervention. The federal government maintains funding access. The consequences, however, extend beyond interest rate management. Large-scale Fed purchases expand the monetary base. Inflation returns. Consumer prices accelerate. The real return on Treasury bonds turns negative even as nominal yields appear acceptable. Foreign holders recognize the debasement occurring and accelerate their exit. The dollar depreciates against major currencies. Import prices rise. Inflation becomes embedded in wage negotiations and pricing behavior. The Federal Reserve faces an impossible choice: continue supporting government funding and accept higher inflation, or withdraw support and trigger a fiscal crisis. This scenario has historical precedent in various forms across different economies. It represents the path of least political resistance. No legislator must vote for spending cuts. No constituency faces immediate benefit reductions. The costs are distributed through inflation, which operates as a hidden tax on savings and fixed incomes. For international businesses, this scenario demands robust currency hedging strategies, accelerated capital equipment purchases before prices rise further, and careful management of cash holdings across multiple currencies. The third scenario envisions structural fragmentation of the reserve currency system. Over a 5 to 7 year period, the dollar loses its monopoly position, but retains the largest share of global reserves. The euro, renminbi, and possibly gold increase their shares in central bank holdings and international trade settlement. No single alternative replaces the dollar. Instead, a multipolar system emerges where transactions occur in whichever currency offers optimal terms for the specific parties involved. This outcome creates persistent dollar weakness, higher structural inflation in the United States, and constrained policy autonomy for American leadership. The ability to fund deficits at artificially low rates disappears. The capacity to impose financial sanctions diminishes as alternative payment systems gain legitimacy. American geopolitical influence, long amplified by financial system dominance, faces structural limitations. For the business community, this scenario requires fundamental strategic recalibration. Supply chain decisions must account for currency zones rather than assuming dollar ubiquity. Capital allocation strategies need diversification across currency-denominated assets. Debt structures for companies with international operations should match currency exposure to revenue streams. The playbook that worked for 40 years becomes obsolete. The monitoring framework for determining which scenario is unfolding focuses on specific indicators. Treasury auction bid to cover ratios measure demand intensity. A sustained decline below 2.0 suggests weakening appetite. Federal Reserve custody holdings track foreign central bank positions. Month-over-month declines exceeding $50 billion indicate accelerated selling. The 10-year Treasury yield itself serves as summary statistic. Sustained trading above 4.5% signals that market clearing prices have shifted structurally higher. Threshold triggers that warrant immediate strategic response include auction failures, where the Treasury cannot find buyers at any yield, foreign custody holdings declining by more than $300 billion in a single quarter, or the Federal Reserve announcing open-ended quantitative easing while inflation exceeds 3%. These developments would represent systemic dysfunction requiring rapid business adaptation. Portfolio positioning for institutional investors and corporate treasurers should reflect these scenarios probabilistically. A baseline allocation might hold 50% dollar-denominated assets, 25% euro exposure, 15% renminbi or broader Asian currency exposure, and 10% in hard assets, including gold. This structure provides protection regardless of which scenario materializes, while avoiding concentration risk in any single outcome. The events of January 2020 constitute warning signals rather than systemic crisis. Markets stabilized after policy adjustment. Auctions continued to clear. The dollar remained the dominant reserve currency. But the reflexive feedback loops are now visible. Policy volatility creates market instability. Market instability constrains policy options. Leadership faces narrowing room for maneuver. The business community confronts a strategic window that will not remain open indefinitely. Currency diversification, supply chain reconfiguration, and capital structure optimization require months or years to implement effectively. Companies that wait for definitive crisis signals will find themselves adjusting under duress with limited options. In highly financialized economies, bond markets enforce discipline that democratic processes cannot. Voters may tolerate fiscal irresponsibility. Markets will not. The constraint is neither ideological nor political. It is mathematical. Debts must be serviced. Buyers must be found. When buyers disappear, everything changes. The flower continues blooming in financial centers across Europe and Asia. Its petals carry implications that extend far beyond botanical metaphor. The infrastructure for a post-dollar world is not theoretical. It is operational. The question facing decision makers is not whether alternatives exist, but how quickly adoption accelerates when the next crisis arrives.